Run through today, I'm not saying buy, hold, or sell. I just want to digest this with you, and then we can take it from there. You can invest if you want. If you don't want, you don't have to either. I'm not a financial advisor, thank God. Okay, so let's get it kicked off. First things first, right? I think the biggest ones is this company clearly missed on about 4 metrics, which I think are quite important. The first one is, Chinese sales, American sales. They had an operating profit miss, and that's not good because analysts expected it to be more, meaning that most of the market actually priced in higher returns. So this is not, these results don't look good to me on the offset. And with a forward-looking lens, right, this company is highly, highly dependent on, I would say, China. It makes up a lot of their sales, and as you know, China's gone into a very strict lockdown with their no COVID policy. So I think I read a stat that about 80% of their production has been halted, due to this no COVID policy, which is quite significant, meaning there's going to be no growth coming out of a lot of companies that are dependent on China for growth. Something I want to bring forth firstly, and I want to preface this video with it. I personally think Nike is one of the biggest brands in the world, if not the biggest. It's definitely my favorite. I think it has a lot of cultural heritage. You're thinking about your Jordans, and even if you go to the UK, your Skeptas. It's been releasing those Air Maxes, which are really dope, man. But yeah, so it's definitely, if you look at your Porter 5 Forces, it's one of the most competitive brands. But if you look at it on the offset, and I'm going on a bit of a tangent here, right? For a brand to be differentiated, you can do it in 2 different ways. Firstly, you have to have a superior product. I don't think it's going to be that easy for Nike to have a superior product, especially if you look at what Adidas is doing. Most running shoes, especially, if you go into lifestyle and branding, it's a bit different, but if you're talking about just functionality, all these shoes are doing the same things, right? And they're pretty much priced the same, which is something we're going to cover a bit later. What are they doing in terms of their pricing strategies, which I think is quite interesting. So that's the one facet of it. You need to have a superior product, which I think is very difficult, given the current circumstances. And then the other one is you should obviously then be cheaper than everybody else. Those are the 2 main strategies I think would get you into differentiating, quite successfully. And I think they're sitting in a bit of a conundrum where I don't know where to place them in terms of that. But I think what saves them is that it's one of the oldest brands. It's a brand you can notice. I'm using it as clickbait right now as well. Boom. Yeah. That's gonna be my, my thumbnail. There's a thumbnail, baby.
When you say that though, how is the competitive landscape for Nike at the moment? In terms of market share, do you know?
No, I don't have the exact numbers, but I do know they're probably one of the more competitive brands, naturally. They sponsor the best athletes. I think they've also been involved with Black Lives Matter. They're very active, and I think their branding is very good, but in terms of their product offering, I've heard that they're better running shoes and stuff. But what I see, and I'm going to touch on this a bit later, I think, do you know what StockX is? And sneakers, SNKRS.
No. Do they verify whether shoes are real or something?
Yeah, so basically what it is it allows you to bid on an auction for a very rare type of shoe. Now Nike, I know your Yeezys are quite competitive in that space as well, but your Nikes do the best. And that's because they've partnered up with, what's the guy from, the Off-White brand. So you have Off-White X Nike, you have Skepta X Nike, you have...
Yeah, the collaborations are crazy.
The collabs are pretty sick. So in that regard, they can charge exorbitant fees, right? So what's happening now is, and I think this is something they've been discussing, is through those platforms, you as an individual, you go and you take part in a Dutch auction, and then you get the shoe or you don't get the shoe at a retail price, and then people sell them at 1,000% profit, right? So I think what will be really cool for them, and if you're just speaking about their competitiveness, is if Nike can actually directly sell those shoes and not through those platforms, So maybe they can sell it at a higher price. The demand on a very basic level is ability and willingness to pay those prices, right? That's what demand is defined as. So there's definitely demand for those collaborations and very expensive shoes. So I think in terms of competitiveness, that's an avenue they can definitely exploit. Yeah. Cool. And then on to the next one. So we spoke a lot about moats and competitiveness, which I think is a lot of fluff. And one of my main rules for investing is actually rule number 3. And it is that you should always look at the numbers over the narrative. So when I looked at this set of results, I think the narrative is very nice. They explain a lot of their future plans and what went wrong, especially in China. But I think what's important is, as an analyst, you should look at the numbers and don't be spun on the narrative alone, you know what I'm saying? Because a lot of creatives can spin you and you could buy something that you don't fully understand. But I think the numbers can never lie. So let's look at the first thing which stood out to me, which I found very interesting. And remember, I'm doing this through the lens of a value investor. So to us, your price that you're paying is very important. And to sum it up very nicely, I'm not going to pay a high price for this company if future earnings cannot justify it or support it, right? Okay, so the first two big numbers that stood out for me was your sales fell about 0.9%, and your advertising was up quite significantly, and as a result we've almost lost 23% in operating profit in these results. That's horrible. That means the operational capacity of the business has declined. Now, so the main reasons you would ask are what? Why would this happen? And that's, like I said before, it comes straight out of China, so they have a lot of inventory on the books and they're not selling at the prices that they're supposed to. So there was one very interesting word I picked up here, you know, when these goddamn creatives do your books, this is what happens. So
demand creation expenses.
Yes, exactly. So they've actually attributed a lot of the advertising costs going up because of demand created expenses. What is that? What is that? I'll tell you what that is. Those are discounts. So they're basically selling these shoes at lower prices. So now you need to ask your question, right? What is the strategy? Are they differentiating through quality, or are they trying to go a low cost route? So to me, if I have to put myself into their shoes, I think they said that because if you're speaking to investors who are expecting high growth rates from, especially in terms of revenue growth in a company, saying that you're selling your product at a discount, and you're probably going to continue doing that going forward, is not a good thing, because that's going to cut into your growth, and this company's future growth is not going to justify its current price. So just to put into perspective, it is trading at a 27 times to earnings. So your price to earnings ratio is 27 times, which is high. It's a lot higher than the average. So you would expect growth. You're not going to pay this if you don't expect the growth. So let's talk a little bit about the outlook. It's slow, like Hugo's running.
I am white though. So.
I mean, they could turn it around. Like I said, Nike's fine, man. You know, it's good modes, as we said before. And also, maybe they can leverage off that StockX, you know, and get some more revenues. And also, there's another thing they can do. They could probably create shoes for fat people. Not athletes, you know what I'm saying? Like, it's like a lifestyle brand, right? I think they've been talking about that as well.
But see, so wouldn't you say that Nike is already has surpassed being, you know, athletics brand? It still is obviously one of the biggest in the world. They have the biggest sportsmen. Yeah, Michael Jordan was their biggest collaboration that actually led Nike to where it is right now, or at least gave it the exponential growth, right? Mm-hmm. But Nike to us, it is a lifestyle brand, right?
100%.
Like, why do you like Nike? It's because it's something, and you whatever their brand values are, you like that and relate to that.
No, big facts, bro. Yeah. Big facts. And I think you can see that very clearly through the collaborations, bro. Like for me, you know, I love Skepta, bro. Yeah. You know, I love grime music, and I think it's great that they're like in the culture in that way, you know. So your sales are down, your advertising expenses are up, and your income, you know, operating income fell 23%. What does that mean? Your diluted EPS actually only fell about 3%. It doesn't seem like a lot, right? But I think looking at that operational number, minus 26%, again, that's your EBIT, earnings before interest and tax. You know, it's crazy that shows there's operational inefficiency there. So that's the number I'll be looking at, and I think it's quite big. But you know what's interesting? They also explained that this was actually driven by onshoring non-US intangible properties. That's one of the reasons why the operating profit was down by that much. How that got past, you know, an accountant, I'm not too sure. I don't know what it means. It didn't say
what is that?
I haven't an idea, you know, but if you read it, they probably onshored property that wasn't in America, so they put it onto their balance sheet as American property, which seems really weird. And I hate it when accounting gets creative like that. But I would guess it's a once-off. They didn't say that it's a once-off, so it wouldn't be the best thing to assume. But I think, let's look at China. This is one of the biggest drivers. This is going to be the most interesting part of this whole presentation. That's where the growth comes from. Remember, I explained earlier that you need to pay a price that justifies future earnings. So this is where it gets very scary for me, right? Revenue was down 20% in China. That's crazy. Earnings before interest and tax down 55%. 55%, that's more than half. Like operationally, it was cooked. So, I mean, so much for a growth driver, right? Especially coming out of China. And then I think, yeah, most of your conviction is going to come from your view on China. Do you think China is going to come back out of the zero COVID policy much better? I personally am not too sure. I think most of it has been priced in. So I think as soon as I think actually Shanghai did recently, declare victory against this COVID, blah, blah, blah. But the thing is, COVID is so infectious, it's probably going to come again, it's going to hit you again. So why would you pay that extra price? Why would you pay up?
I think they've declared victory once before as well. So.
Yeah, exactly. Exactly, bro. Good point. So, this increased demand creation expense, discounts is also another issue I'm seeing. They're probably going to have to do that more because they have a lot of inventory on the books. But I think, like I said before, if they could just change their tilt and maybe focus on getting their margins up in terms of using some more, what would you call it, low supply products or like Veblen goods, to take it back to economics 101, you know what a Veblen good is?
No.
There's like a good that the demand for the good increases, the more expensive it gets, like a diamond.
Oh, yes,
exactly.
Yes.
So how I remember it is like Veblen, very expensive. I'll never forget that. But yeah, I think that's an avenue they definitely need to start exploiting. But currently as it is, there's a lot of fluff around this, and I think they're just piggybacking off the brand and the cultural heritage, but the numbers look bad to me. So they need to figure out how they're going to differentiate, and they need to stop creating these demand expenses, whatever the hell they're calling it, discounts, it's not an easy thing to deal with, especially if you have so much inventory in China. I mean, people are not buying shoes anymore. You're just at home. Why the hell would you? Right? Cool. What else is there? The outlook. So for this quarter, just to give you a bit of a roundup, we can all agree, revenue was quite flat, but I think it's a lot worse than what it looks like. So your earnings per share grew about by 3%, but if you look at your operating performance, that's horrible, 26% down. In China, your EBIT was down 55%, So I think just in terms of the last quarter, it was a horrible, horrible print. And they also had some negative impacts because of foreign exchange, but we're not too interested in that. Those things are always going to be there. It's always going to fluctuate. You can't control that. But I think they're going to continue to experience more gross margin pressures. So this is also something I want to give across to you. If you look at your gross profit margin, right, I think theirs was about 45%. What does that mean to you? When you're this means that they can mark up their products by 45% on average across the books.
Yeah, because that's what they're doing,
exactly.
Right? Yeah,
exactly. So if they're talking about discounts,
which is a healthy gross margin.
No, it's healthy.
Yeah. But for consumer goods.
For sure. I mean, it's a brand, So they've always had that superior. I guess they had superior products, right? So they could justify it. But now they have a lot of inventory and they're selling at discounts. Remember, they were talking about this demand creation expense. So naturally, your gross margins, they definitely going to experience a lot of pressure going forward. So I don't think it's going to be 45% by the end of the year. I think it's going to be a lot less. And that just speaks to the growth outlook as well. So that's just one of my predictions. What else is there? What really pissed me off? They didn't have a cash flow statement in their results, So they didn't issue one. So you'll have to wait for it, or you have to just calculate your own. But I think don't hold your breath. So if you just look at the numbers, we have your sales are down, inventories are up. Just to put a number to inventories, because I've been mentioning it a lot, it was up 23%. They're not selling anything, so EBIT
in China,
EBIT was down 55%. So that's your earnings before interest and tax. It's quite significant. So if I guess you can just infer that the cash flow statement is not going to look good. So that means they don't have the same level of cash to reinvest into the business or pay out dividends, right? So as an investor, these are the things you're looking at. And currently for me, earnings at 27 times, this thing is way too expensive. But I'm waiting for it to get cheaper, and then I might have another look at it. I still love the company. Guys, please sponsor me. I think I look really fucking good in this, by the way. But anyways, that's me. Thanks for joining me, Hugo. Thanks for joining me, members of the SPOT. And I'll hopefully see you soon again. Ciao.